Clients withdrawing your 25% tax-free cash too early is a massive problem in the industry. The FCA is really hot on this right now. The reasons for this are fairly obvious. A lot of people are potentially going to end up in later years of their life and not have enough money for their retirement, which is what their pension was there for in the first place. So today, I'm going to be running through the top 5 reasons why you should not be doing this, or why you should consider before making a tax-free withdrawal from your pension scheme. So number 1, as I've just mentioned, a lot of you are going to reach the later years of your retirement, your 70s, your 80s, hopefully your 90s, and potentially not have enough money to fund your retirement. You have to remember that your pension was obviously made for your retirement, not for your pre-retirement. So if you're 55 or about to turn 55 and you're thinking, oh, I've always wanted that boat, or I've always wanted this, or I've always wanted that holiday, or I've always wanted to the conservatory, whatever it is, that's okay and that's fine. And that's part of natural life with your financial advisor. You should be doing proper cash flow planning to factor in these type of events, look at what capital you already have. But if you're withdrawing the money now, you are not going to have that money later for yourself in retirement. The second reason is to be smart. You get a 25% tax-free cash lump sum, or pension commencement lump sum as it's professionally called in the industry, irrelevant of the size of your pot. So say, for example, you transfer £500,000 DB into your SIP and you're age 55. You might say, Dominic, I want to take 125 grand because I can and it's tax-free and I want to do that. Yes, you can. But say you're 55. You let that pension pot grow for 5 years or 10 years. Of course, past performance is no guide to future performance, but over the course of 5 or 10 years, you would expect your £500,000 to have grown dramatically. Say over the course of that 5-year period, you had a 20% growth rate, okay? Your pension pot would then be worth £600,000. Your 25% tax-free element of that would obviously be worth £175,000 instead of £150,000. So you've effectively made yourself £25,000 extra tax-free cash by simply doing nothing and waiting. Now, if we actually look at market returns, a 5-year market return on our balanced portfolio, which is circa 65% equity, has actually been around 52% or 48% looking this morning over a 5-year period. So actually, the amount of tax-free cash that you have could potentially be even greater. Again, past performance is no guide to future performance. Of course, there is the risk that a portfolio could go down, but over the course of 5 or 10 years, there's a far higher chance you're going to have a larger pension pot and as such, get a larger tax-free cash out of the UK government. The third point on my list is inheritance tax planning. Okay. If any of you have a good financial advisor or you've done your homework, you will know your UK pension scheme, whether that be your DB, your DC, your SIP, even QROPs, which are no longer not UK pension schemes, but typically Maltese pension schemes, they are free from UK inheritance tax. So your pension pot is the most tax efficient tool you can use to pass money onto your generations beneath you. So when you're taking your tax-free cash out, say again, you have £500,000, you take your tax-free cash, 125,000, you put it in your bank account, that instantaneously will become part of your estate for inheritance tax planning. Now, as you all know, you have £325,000 for inheritance tax or £650,000 per couple. For a lot of people, they will be over this instantaneously with property and this and that. Yes, your main residence, you have exemptions, but if you're over a particular size of your main residence, it's still going to come under inheritance tax. So you need to be really careful. If you're taking out the 125, you have a dead set plan of exactly how you're going to use it, and you really need to make that withdrawal. Okay, as part of proper cash flow planning with your financial advisor, you can work that out. But if you're just going to take it out because I can and it's 25% and I want it, and you put it into your bank account, you're running a massive risk. The majority of my clients are going in the other direction. They're trying to say, Dominic, how do I get as much money as possible into my UK pension scheme so it's free from inheritance tax and pass it on to my kids or my grandchildren, whatever it is. So when I have clients trying to go the other direction, I kind of try to remember and remind them, slow down. Do you really, really need to do this? And the fourth point on my list is capital gains tax. As we just mentioned, UK pension pots are free from inheritance tax, but they're also free from capital gains tax. This is a huge advantage to you. The UK government is effectively allowing you to save over the long term because they want to encourage people to save for their pensions, so effectively they don't have to fund you later in life is probably the real story. But anyway, it's fantastic for you. You have free from capital gains tax. It means your pension pot can grow every year and you have no tax taken out of that account. If you take the other example, say an interest account at the moment, you have a 2% rate of interest. You will automatically see on your statement that you get tax deducted inside your current account and it goes directly to the UK government as part of capital gains tax. So once you take money outside of your pension pot, or however you're going to go invest it, if you invest it inside an ISA, then yes, you won't have any capital gains tax applied to that ISA. But the ISA limit is £20,000 per annum, and an ISA is not free from inheritance tax. So it makes absolutely no sense to take money out of a UK pension pot and then invest it anywhere else other than a UK pension pot, which you actually can't do for recycling rules. So it's really important to take note of that. Don't just take money because you can and it's there on the table. Think smartly about it with your financial advisor. And the fifth and final reason why you shouldn't take your pension commencement lump sum too early if you don't need to is compounding. Okay, compounding, as you all know from school, is your biggest friend when it comes to savings and investments. Compounding is effectively how your investments and any growth of your investments is reinvested instantaneously on a daily, weekly, monthly, yearly, annual basis to ensure that it's reinvested back into the market. So effectively you have growth on growth. So if you take a very simple example, say you have £100,000 and you have 5% growth rate. At the end of year one, you'll have £105,000. In year two, that £105,000 is invested at a further 5% growth rate and it starts to compound in effect. As I said, the compounding actually happens on a daily basis. When you have growth inside your fund, it's instantaneously there and reinvested because we use accumulation shares, typically speaking for clients, rather than income shares. So again, it's really important. And by taking out that 25% needlessly, you're effectively ruining or de-leveraging 25% of your portfolio from a compounding perspective. So that's the top 5 reasons why you shouldn't take your 25% tax-free cash too early. If you want to speak to myself or one of our senior financial advisors to go for a proper voyant cash flow plan modeling of whether or not you should take your 25% tax-free cash, get in touch below via the WhatsApp or the link to the Calendly, or you can head over to the website, leave your inquiry, and you can start having a conversation with ourselves. Very often the outcome of this is not for us to say, no, you shouldn't take your tax-free cash. You can do whatever you want with your tax-free cash. It's your money. But we need to help you be an informed decision to understand what are the disadvantages to taking my tax-free cash. Because a lot of people have the mindset, it's mine, I can take it, so I want it. Yes, it is yours, but it's going to be there next year. It's going to be there at 60, it's going to be there at 65, it's going to be there at 70. You only have to start doing something with your pension pot before age 75 in the UK. So you actually have a very long time to maximize your 25% amount. Also, it's often a case of a compromise. So a client is say £500,000. Say, Dominic, I want to take my tax-free cash. I'm like, okay, £125,000. What exactly do you want to spend it on? Oh, I need to get my conservatory done. I'm like, what, £125,000? Oh no, the conservatory is going to be 20 grand or 15 grand. Okay, so why don't you take 15 or 20 grand? They say, oh, I thought I had to take all of it or nothing. No, you can take as much or as little as your 25% tax-free cash as you want. In that example, say a client wanted £20,000 pension commencement lump sum, we would crystallize 80% of the portfolio, £60,000 would stay invested, crystallized inside the pension pot, and the 25%, the £20,000 would come out to you as your tax-free cash. You can leave the rest of the money in there until the end of the pension plan. Guys, I hope that's been a useful video for you today. Let me know if you have any questions at all, and I look forward to speaking with you soon. And as always, please like and subscribe to the channel to let everyone know that you're enjoying the content.